best. Well, welcome to the special bonus for the World Outlook Conference. I mean, our goal at the conference was straightforward, is straightforward. We want to give you the best value. We want to help make you a success when it comes to your own personal financial decisions, especially obviously through the investment markets. Well, we've got a special bonus for you. Tony Greer was planning to come to Vancouver in person. Personal issue arose and he couldn't make it. So he said, you know what? Well, I'll be willing to do a special presentation for the entire audience from the World Outlook Conference, and here it is. I think you're going to love it. Welcome to the World Outlook Conference bonus, and quite a bonus it is because I have Tony Greer with me. You know him as the founder of TG Macro. You can find him on Substack, on Twitter, etc. But here's the key. Come on, here's a guy with 25 years in trading, 15 years in writing a daily newsletter, the daily or the Morning Navigator rather. That's why people line up to hear this guy's opinion. And I am one of them. Why? Because of that experience, that rare combination, though, of analytical skills, but practical experience. Tony, thanks for doing this with me.
You're very welcome, Mike. I'm honored to be here. Thanks for having me.
What a time. You know what I mean? Like, what a time that we're in. And I just want to remind people that I'm going back now into, I think, November 14th off the top of my head. Very clearly stated on TG Macro, the Morning Navigator, everything you do on Substack, etc. You said a bell just rang. Get long the market. Now, that was very lonely at that time. Other people jumped on. It took them 6 to 7 weeks. I think that would be my guess on average, not day of. And that's what you said, day of. Get long stock. So no wonder I want to know. This is the terrible thing about the job. It's what have you done for me lately? So Tony, let me give you a few minutes to go through some of the markets that you're looking at. I'll come back to a Q&A, but let our audience know what's up for Tony Greer.
Yeah, sure. So Mike, I'll cut to my, I got a little presentation prepared, and so that I want to give you guys some visuals to go along with my views because I feel like they help them and kind of drive the points home really well. So I'm going to go to a screen share now and run through this presentation here. Boom. Okay. Should see that now, Mike. So what we're going to do is, my presentation is basically that I have an extremely bullish stock view. I am neutral on treasuries, which is what contributes to the bullish stock view. I'm bullish gold and Bitcoin, and I think there's opportunities in technology and in the uranium sector. And I'm pretty neutral in the energy sector. I don't see an oil trade. So to begin, I like to start by pointing out what actually happened on November 14th, and I call that the day that will live in infamy. On that day, CPI was reported in line for October, but the market response was overwhelming. Like if you're a macro guy, you kind of sat here and stared at your screens at the end of November 14th for like hours saying, holy shit. Stocks and bonds exploded in large magnitude. The dollar and yields fell in large magnitude. 17 sectors of the S&P saw 2 sigma breakouts, right? Of those sectors, here's their performance into the quarter end, right? I put a slide together. You had sectors like home construction up 30%, regional banks up 27%, home builders up 25%. And these were the quarterly performances, right? Not on the year or in the last 5 years. This is just in the quarter. So you had all these interest rate sensitive sectors of the market jump up and take off. And in my opinion back then, and still is now, this is really sustainable given rate path expectations and the recent commodity weakness. So I've got this slide here where I point to exactly what went on November 14th on that day. It was when we broke above the 100-day moving average in the S&P, which was the final moving average for it to hurdle, right? And in my sort of trading parlance, I call that going blue sky trading, which means that at that point, once the security gets through the moving average resistance levels, it can resume its bull trend. And so that's exactly what the S&P did. And you can see it there surfing above the 50-day moving average. It's wildly oversold and wildly overbought. And it's been that way since November and can remain that way for the entire year if it has to. That wouldn't shock me, but I'm sure we're going to have some episodes where it's going to get to, where it's going to get to flatten out. So I've got a range bound case for bonds, and I'll go through this super quick. we're coming out of a massive bear sentiment bubble in bonds where we thought, this 3-year bear market was going to go on forever and rates were going to go flying higher with all this inflation. And then the commodity markets collapsed and we started pricing in interest rate cuts next year. And we're still seeing a good back and forth in the economy. We're seeing green shoots of inflation and strong economic data that keep yields from falling. And we see the economy still facing, challenges in employment and GDP and manufacturing. So you can make a case that the long bond maybe put in a bottom in 2023 and can stay range bound for this year. I look at 2-year yields and they started, they started in their range bound sort of activity back in 2022. They peaked out at around just below 5 and bottomed out at around 4, and they remained like 3.5, bid at 5% ever since then, ever since the early part of 2023. So I think that the yields can stay sort of in this range this year as the market gives you a good back and forth. The economy, I should say, gives you a good back and forth on sort of what's going on. Like I said, we'll see, strength here and there, weakness here and there, and yields won't have anywhere to trend. For me, the equity market is good to go as long as we don't see a startling steepening of the yield curve. And what'll cause that, Mike, is we'll get some bad economic data and twos rates will curl over faster than the rest of the curve because it'll be anticipating that bad economic data and a response from the Fed of potentially lowering rates. So that would spike the yield curve 2s, 10s back towards 0. And when that happens in a super fast pace, you see the reaction in the stock market and it causes a sell-off. Because the steepening of the yield curve means that the bond market is dealing with an uncertainty. The VIX tends to perk up with that. Everybody buys downside protection in the stock market, and you see the stock market go through a couple of day period of volatility. But I still think we've got a great bull case for stocks like I've got on this slide. I see that we're exiting, most important for me, and I'm going to go through this analog in a minute, is that we're exiting a period of rapidly rising interest rates. Right? Bond market dislocation risk due to inflation has been removed, right? We're no longer dealing with 9% headline inflation. The Fed did an unbelievable job getting it back down towards 4 or 5%. It's been steady at this level and not bubbling up so far. So there's no more bond market risk of a dislocation. And I think that that's what November 14th, that's the real message that the bond market sent. And so I've got this analog in my head where rates are likely to be sideways to lower as the Fed battles inflation sprouts and economic weakness, and stocks flourish because rates are range bound. This reminds me of 94 when we rose Fed funds from 3 to 6%. And I'll show you the slide right here because it's a great one. We rose Fed funds from 3 to 6.5% or 6% during the year to slow down a super hot economy that was showing signs of inflation. And as you can see from this chart, in 94, the stock market had a really volatile up and down year and went nowhere, right? The S&P lost 1.5% in 94. Going forward, rates were range bound for 4 years, right? We peaked out at 6% in 95. We traded at a low below 4.75%, way out in 99. What did the stock market do in that period? While Fed funds were steady as a rock, it erupted, right? Up 34% in 95, 20% in 96, 30% in 97. This is otherwise known as the dot-com boom, which everybody remembers, right? So I see similar, I see similar tailwinds of technology, right? We've got NVIDIA exploding with the AI story. We've got cryptocurrency exploding, which is another sort of technological tailwind, in my opinion. And to me, this whole story rhymes with 1994, so I can stay bullish, until interest rates really shake themselves out of the recent range, right? We've got an S&P breakout right now above 5K. In my opinion, it is pricing in some potential shades of another Trump administration. Right? It looks like he could be the clear front runner if he stays out of jail due to lawfare from the other side. NASDAQ 100 is breaking out behind all the big name stocks, the Mag 7 that are taking up all the oxygen in the room. But the reality is that the market is rallying, right? NVIDIA is $1.5 trillion, well, bigger now, probably 1.8 market cap stock. It's 70 to 90% of the global AI chip market, and that's what investors are looking for right now. You know, it does resonate and rhyme with the dot-com boom when investors weren't as price conscious, they were more idea conscious, and they had to be off of the zero boundary of NVIDIA. And if they're tagged to an index that's got NVIDIA in it, they can't be underweight or they'll fall behind on that index. So that's a conundrum that a lot of a lot of portfolio managers are facing right now. And this is not a buy recommendation of NVIDIA. This is just an observation that it has officially gone parabolic. Where she stops, nobody knows. This chart's important to me because I see a big pile of money in money markets that's been growing as rates have been going higher. I can imagine that it's going to level off at least if we do start lowering rates. And in my opinion, this is money that's sitting in, 4 and 5% treasuries and 2s and 10s and things like that, where when you start having, a 10% quarter in the S&P, where the NASDAQ is up 15% and NVIDIA is up 25%, people are going to say, this 5% money market is nice, but let's get some of that technology on the books. And then you're going to have this sort of, you'll have a little bit of performance chasing in the equity rally into a retail push into the equity rally. And I think that that's what makes it somewhat sustainable, right? Now, to switch gears real quick, and I'm going to cover this. There's a super bullish case in the uranium market, as you know. It's 15% of global and 20% of U.S. electricity production likely to grow. Demand is expected to double by 2040. Supply is extremely tight. 2024, it looks like we're going to have about 160 million pounds of supply, 210 pounds of demand, a million pounds of demand, and one of those do the math sweetheart trades where, for a while, there's no place for uranium to go but up if utilities want to continue to keep their nuclear baseload power going. So you've seen Sprott Uranium Trust, which is the sort of vehicle of choice. That is exposure to actual uranium gone, parabolic essentially over the last year and a half from 10 to 25. That coincides with the price of uranium rallying to over $100 a pound. And inventories are still extremely light, and utilities still need uranium to keep their reactors going. So you've got the uranium miners are rallying fairly sharply. They're in the leader pack this year. It's largely made up of Cameco and the Sprott Physical Uranium Trust and a couple of smaller uranium miners. But these are bull markets that I think are in still early stages that are worth participating. Then I've got a bull case for Bitcoin, which looks pretty good today as it trades up above 50K and then back off a little bit. Excuse me. But I noticed that Bitcoin post Bankman-Fried, essentially since they threw the book at that clown, has been trading much better, and markets do that a lot when you remove sort of a compliance albatross or sort of some fraudulent albatross. They tend to trade better. It looks a lot like a flight to safety hedge. There's been a clear response of it since the Israel attacks on October 7th. We just had all these ETFs get approved, and now we're going to have the corporate, buyers of Bitcoin coming into those. We've got limited supply of coins. We've got a great trading vehicle that looks like a great levered bet on risk assets. And it looks like something that's sort of increasing practical adoption. So I've got a lot of bull cases for Bitcoin. Technically speaking, the chart looks great, right? It's traded out of this bull channel that it was in, but I kind of point out where Sam Bankman-Fried was arrested, and that was the bottom. And then we had the Hamas-Israel attacks, and Bitcoin really took off and responded to that. Then we had this ETF event where, it was a sell the news event that turned out to be a very shallow dip and then a trip back to the highs. So Bitcoin is very much in motion this year, and I think probably worth trading from the long side. The bull case for gold, it's always been fiat currency insurance for me, but big case for me now is that central banks are divesting from U.S. treasuries and likely putting that money into gold. So I think gold is going to be a good safe place for your money, not necessarily looking for a massive return, but it's money that's going to be there when you go looking for it. And really important socially, I've got a circle drawn on that Boeing incident when the door flew off the Boeing 737 Air Max at 16,000 feet. In my opinion, that was the end of diversity, equity, inclusion in the US. And we'll see if that happens, but that's just a separate social thing. Since then, Sports Illustrated has gone under. You've seen Jamie Dimon come around and say things like, you've got to support, you've got to stop bashing Trump supporters, et cetera, et cetera. So the whole world is sort of changing a little bit from this fast-paced globalism that we've been seeing for a long time. So that's the end of my sermon, Mike, and I'm going to quit the screen sharing so we can talk again, and you can pick that presentation apart 8 ways through Sunday.
Well, first of all, that was excellent, absolutely excellent and clear. And there's so much I want to ask you about from a trading point of view, from an investing point of view, which I love that you made that as investor. Here are the trends you're seeing, here are the moves you're seeing, and that's a different scenario for TG macro trading, where you will be in and out within those trends. Doesn't mean you've lost faith in uranium, for example, but you don't mind scalping it a little bit there, taking some profit off the table, looking for an entry point. So I want to divide my comments or questions along those lines. But let's summarize a bit, Tony, about what those sort of broad trends are. And I'm seeing very interesting to see that on an interest rate front, you're not seeing this 9 interest rate declines in the next year kind of scenario. You're seeing a tighter trading range than I think many people are.
Yeah, Mike, it's one of those things where I think we're going to have a really good push and pull. And I'm not an economist or a biologist, but it seems like this is the way markets behave. I could see where rates can stay sort of range bound because the inflation genie isn't going to go right back in the bottle, right? We're not going to just pivot into a complete deflation scenario. Between supply chain issues, there's obviously friction in the Middle East. Saudis have the interest to keep the oil price up at some level. Like, I just don't think we're going to see a complete commodity collapse this year. So we know that consumer level inflation is still there, right? People are still feeling the sort of, bang of that higher grocery bill in their pockets. So they're still underscoring inflation in the markets. But as you've just seen in the last several weeks, there are massive amount of layoffs happening right now. So I could imagine that I can see that sort of filtering into the economy in the next several weeks and months. And maybe we get some bad data, in the weeks or months ahead that keeps rates from curling over and going straight down and pricing in 6 rate cuts next year. It just seems like that was too extreme. So it seems like for me that we're set up for rates to be sort of range bound. The equity market is going to be the best investment in town right now. And it's got, go ahead.
Well, I was going to say, and it's clear that people have to decide, first of all, regular things like risk tolerance, but what their longevity is, because I think if I'm a longer term investor and the way you identified it November 14th, and you see that trend continuing, I'm looking forward to some dips so I can get some investment dollars, employed. I'm not worried about the dip. I'm saying, oh, thank you for putting that on sale because I was buying it anyways.
Right. Yeah, there's, that's why I feel like, this market, everybody on Twitter and people that read market sentiment, everybody's aware that, we are in CNN's Fear and Greed. We're at extreme greed right now, right? The reading is like number 78. The AAII Bulls Index is over 50, which is like, bulls abound. Right, the VIX is buried at 12, 13, right? The thing can't pick its head up past 15, no matter what kind. We just had a regional bank blow up, and the VIX couldn't get north of 15, right? So it's like the market is obviously complacent and running on the pure tailwinds of this unbelievable technology-led rally. And I say led because technology is in the lead, but I can make a pretty good case that there are some other sectors rallying too. And I guess the point is, there's going to be money on the sidelines, like a part of that $8 trillion gorilla that's in money market funds and all the funds that money managers have on the sidelines that are going to say, hey, we get a 5% dip or God forbid a 10% correction in the S&P, we got to be there, because this whole overlaying economic situation is not changing. right? Everybody just priced in 6 rate cuts for this year already. Like it looks like the March rate cut is out the window, and we'll see what happens from there. So the market is adjusting to that. I just feel like a setup of a great back and forth leads people into the equity market if rates are stable. And the longer rates are stable, the longer people will get friendlier with the stock market. So there's going to be money there on a dip. I'm looking for a typical waterfall scenario where I've got that sort of checkbox, and that gives me the signal to get into equities on the dip. So we'll see if we get one.
And I'll recommend people subscribe to TG Macro, the morning navigator, the morning navigator, because if they're traders, you're going to give them all the information they need when you see those kinds of things developing. And I'm thinking on the broader picture, the longer term picture, the old adage, Tony, you're well familiar with, but markets don't want to go down, go up. And I'm thinking we give it a lot of reason to go down. I mean, the interest rate scenario isn't quite working out the way people anticipated, say, 6 weeks ago. Obvious geopolitical risk. My goodness gracious, we could do something on that every day. And it's things like that. Normally, you'd expect some sort of a contraction in that, or and we're not getting it. And that's the old, well, markets that don't want to go down, they're telling you they want to go up. So again, it's within that framework that you say there'll be short terms, ups and downs. There's going to be disappointments, as you said. Sort of green shoots for inflation. Oh my gosh, inflation's coming back. Get a market reaction. Oh my God, rate's going to bump a bit. But have a clear picture of that longer term. And traders, of course, take advantage of that volatility.
Well, yeah, you're seeing that on the screens now, Mike. I pointed out this morning that the stock market, the S&P, as it floats above 5K here, is now in the phase where it's sort of, I call it trading like water, where it sort of just finds the weak points and goes after them. Like the short covering today in the solar sector, it's up 4%, right? Does the solar sector, like, is there a big change in the solar world or anything like that today? There were no headlines, no nothing. The sector is still down 11% on the year, but that's where the market came after the shorts today, and they had a cover. We had a fresh breakout today in home construction. ITB trading 105.48. That's a new high for the move. Everybody was so concerned that if rates were going to be, if the economy was going to weaken, the housing market was going to collapse. They were concerned that when rates were going higher, that the housing market was going to collapse. The housing construction stocks are telling us that the housing market is not collapsing. So today was a fresh leg of a breakout there. So there's going to be, choose your breakouts. Don't overstay your welcome, but there's going to be a lot of trading opportunity just like that this year.
Let me just a couple more quickly, because I don't want to, you discussed them, but I want to come back to gold, for example.
Sure.
And really interesting, your gold and Bitcoin sort of forecast, again, looking for people looking for a store of wealth for protection against crumbling purchasing power, which is music to my ears. I think that's the number one challenge for individuals. But just reiterate what you were saying about both just quickly.
Absolutely, Mike. Gold is trading near all-time highs, right? And it's hovering right at the all-time highs. We had a triple top on the charts in 2080 for the longest time. This year, we finally climbed up above it in the beginning of the year, right? We broke that new high, and me and every other gold trader on the planet thought that was going to be the path to like 2,500 and then 3K, and it was going to happen fast. That didn't materialize. Right, we got a high of 2135 on the board. We fell back to 1950, and now we've been range bound, sort of above 2K ever since. But I think the dynamic is that gold has proven that it is sort of weathering a stronger dollar. Gold can rally in that scenario, and it rallies just fine with a weaker dollar scenario. We've got a scenario where we know that China is selling a massive amount of treasuries, and they have been, and other central banks have been. What is the central bank going to buy if they're divesting from treasuries? You can't tell me it's going to be anything else but gold, because what else would it be? And so we've seen central banks inhaling gold, and that's why there's no pullbacks. And even more interesting and perhaps more important to me is the regular physical buyers are now sort of at the market above 2K, right? And in gold, if you've traded the gold markets, you know that the physical buyers are the people that you call up when gold is dipping and gold is selling off, and you say, hey, do you want to buy gold at this price? And they always show up on dips. And in speaking with another professional in the markets named Nikki Shields in a podcast that I did, she's a real expert on the physical trade. and she works out of a trade house that has its central office in Geneva. And she said the physical buyers are at the markets above 2K now, and they're not being price sensitive. Like the demand is real and it's here. So if the physical demand, which is usually $100 or two below the markets, is chewing it up and central bankers are buying it, I just feel like this is a good place for me to put my money, right? And like I said, I don't know if gold's going to return 2 or 12% or be down 2% this year. I don't really care. I know that gold is in a stable condition right now, and that I don't have to worry about it coming apart. And so I'm happy to do the sort of Felix Zulauf trade, which is have all your money in gold, and when you buy something, sell some gold, use the dollars, and buy whatever you want.
Let's talk just very quickly to finish off with Bitcoin. Just a quick word, because I thought, did the world change when they had the ETFs being okayed, when all of a sudden some major mainstream kind of financial houses sort of got on board with that. The market took a dip, which I thought would just simply, buy on rumor, sell on news kind of thing, and now has recovered. Just, a little perspective. Are you more, not, I don't want to force bullish into your mouth, but, more keen on it than say you would have been 2 years ago before all that happened?
I'm a price action junkie, Mike. Yeah. And I am a pattern recognition guy. And, it's just like I recognized that it was struggling around 70K with all the laser-eyed people telling us have fun being poor, right? Those sentiment signals were very powerful. And then finally, Bitcoin came off and deflated, right? It got left for dead at 15K, and everybody was just like, stop talking about it. Stop dead talking about it. Nobody was texting me on Sunday morning at the bagel shop when I was getting my bagel saying, hey, look at Bitcoin making a new high. Like, all it was over. People got rinsed. Nobody was going into their Coinbase account anymore, and you didn't want to hear it. And then just like every other market that gets left for dead, it comes back and comes alive, right? And from the time that they arrested Sam Bankman-Fried the first time, which was kind of that skeevy, fraudulent albatross that was kind of rumoring, milling around the Bitcoin markets, that cleaned that up, right? And whether it was just figuratively, spiritually, or actually, money came into the Bitcoin market and it got off the bottom and it traded up to 20K or whatever it was. And then we had the Hamas attacks, and that was, to me, and I don't want to really talk about that, it was a terrible thing to witness, but the number one response to that was cryptocurrency. And I don't know if there was a direct link or whatever, but crypto took off when that happened. And that to me is another thing that makes you sit up in your chair and say, wow, did this become the new flight to safety for, global issues, saber rattling, violence, things like that, things that make you scared that there's another shoe to drop. So the price action's been great. And that whole thing led right into the ETF episode that you highlighted, and we've come out of that and made a new high. To me, that's the kind of things that you need to see in a market that says something to you, says that it's going to higher prices, right? It's selling off on the fact, but it's holding the dip and in a short time attacking the highs again. That's ferocious price action, no matter how you slice it. And I'm no expert on, the Satoshi paper or, the inner workings of Bitcoin or the halving, but I recognize price action like this. And now that it's got a doorway for any corporation that's got people that like the way this is trading and recognize this pattern recognition and want to have some on because they feel that it expresses the view that they're in touch with, that door's been kicked wide open, and I could see money flow coming into it for weeks and months, and we'll see what happens and how it reacts to the other macroeconomic news, but it's finding its place in the macro world as, a levered bet on assets, and people are going for it. So not a move I can fade.
Absolutely terrific stuff. And I'll tell people in the show notes, I'm going to include everything about, we'll get the slides, of course, but everything about where to contact, get the Morning Navigator. You see why I read it every day. This is a great example of why I read it. I have my long-term views that are certainly influenced by Tony, that we arrive at the same conclusion many times, but, and me influenced, but it's also giving me that daily break on everything. But also you can find him on Twitter at TG Macro. I'd recommend you do that, and we'll give all those details. In the meantime, Tony, people should know this behind the scenes. I've already put him on the hook. I said he's coming to Vancouver next year for the World Outlook Conference. And I can't tell you how much we're looking forward to it. But in the meantime, please accept my sincere thanks for doing this as our World Outlook Conference bonus.
I had to make it up to you, Mike. I was really, really troubled that I couldn't make it out this year. When I sort of got a late data point, and I don't like doing things like that, and so I apologize. I had to make it up to you, and you know, I'm dying to come back to Vancouver for another conference. So if it's given the invitation, I'm going to jump on it.
It'll be a big invitation, a big one. Your wife's going to go, what the hell, the size of that coming in the door? It's going to be an invitation from Vancouver. Tony, thanks so much.
Thank you so much, Mike. Thanks for having me. You're the best.